Is it time to retire yet? How many people are thinking that on a daily basis? They're going to their jobs, just driving into work, looking at the clock, can't wait to go home, can't wait till Friday, blah, 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 and they can't wait till to retire. But who the hell says they can even afford to retire? Are you prepared to retire? How much money will you have in retirement? Do you have a retirement? Are you relying on the government? Are you relying on Social Security? God, I hope not. Anyway, the point of this video is I want to talk about the two main retirement options that most people have or should have, and that's 401k and IRA. Those of you that are lucky enough to have a pension, congratulations. But that does not mean that you should not contribute to one or both of these as well. So let's just dive into each. As you can see, I have a chart. I'll cover a few interesting facts. The traditional 401k it was actually invented by Ted Bana. It's a qualified employer-sponsored retirement plan that eligible employees may make salary deferral contributions on a pre-taxes basis. The Roth 401k came out in 2006 when it was authorized by the United States Congress under the Internal Revenue Code. Most people don't know whether or not they have a Roth 401k. But if you have a 401k, I would advise you look into that. We can get into that later, but anyway, a Roth 401k is an employer-sponsored investment savings account that is funded with after-tax dollars up to the plan's contribution limit. So traditional 401k, pre-tax; Roth 401k, post-tax. Traditional IRA that came around in 1974, that was established in the United States by the Employee Retirement Income Security Act. It's an individual retirement account that offers tax advantages the year the contributions are made. Roth IRA. This came around in 1997. It was established by the Taxpayer Relief Act of 1997 and named for its chief legislative sponsor, Senator William Roth. It's an individual retirement account in which contributions are taxed upfront, so can be withdrawn tax-free at retirement. All right, so let's backtrack real quick. Do you have a 401k? Obviously, you need an employer to have a 401k. I mean, there is options where you can get it on your own, but it's not the same. But you basically need an employer unless you're self-employed. So when you set up the 401k, for you to determine whether or not you have a traditional, you're going to have the traditional option, which is pre-tax dollars. So you need to determine if you also have the Roth option before you even look into what's important, what's not. So you typically would see that, you can either ask your HR department, who should know, or you can just go into your 401k account, and where you choose the percentage or the amount that you contribute from your check, it'll tell you pre-tax. It should say pre-tax, or it might say traditional, I don't know, and then it should say Roth underneath it. So it should have two options. So you can put 50% there, 50% there, or you can put the 100% in either one. But that's where it is on my retirement account. So I would advise you, if you're interested in the Roth option, to take a look at that right after this video. IRAs, obviously, this is not employer-based, so this is through banks. So you go to a bank, you open an IRA. Whether or not you want traditional or Roth, we can go through that now. So that's basically the summary of the history and what exactly a 401k and a IRA is. So let's go through my beautiful chart I just wrote up. So as you can see, here's the plans: 401k, IRA, and then I have it split: traditional Roth, traditional Roth. Those are the dates. As we just explained, yes, 401k is employer-based, IRA is not. As far as maximum contributions, as of 2019, you can contribute up to $19,000 into your 401k. But, the traditional and Roth have the same limits. So, or if you're doing both, it's combined. So, the IRA 2019 maximum is $6,000. Both of these went up a little from 2018. A little, nothing great. I think it should be higher if you ask me, but whatever. If you're 50 or older, you can also contribute additional on top of these limits. And the 401k will let you do another 6k, and the IRA will let you do another 1k. And I guess the idea behind that is if you're getting closer to retirement and you're worried, you can put a little more. Everyone else can't because they're going to make too much money. Now, there is, for those of you that don't know, there's a total maximum contribution and for the 401k. This is between employee contribution plus employer contribution. So between the two, it cannot be greater than $56,000. Obviously, even with these two, $25,000, 100% match, that's $50,000. You're likely not going to hit that based on these limits. So unless your employer is a hell of a guy and he's just throwing you money, contributing for you, you're probably never going to reach that. The IRA, there's no total max. The maxes are what they are, because obviously there's no employer. So income limit, 401k, no income limit. You have the job, you have the 401k, done. Doesn't matter how much you make. IRA, there's no income limit on the traditional. There's an income limit on the Roth. Single, if you're single, you must make less than $137,000. If you're married, you must make less, combined, less than $203,000. Obviously, that's telling you something right there, right? Think about it. Let's move on. Investment options. So what this means is you're obviously putting money into this account. Where is it going? You have to choose investments where it should go. So, and I'm saying your options are limited on the 401k because it's pretty much all index funds that you have to go through. You cannot choose individual stocks. If you can, then you're lucky. But I know I can, and I've been through several companies that have had 401ks. So for the most part, then my understanding, yes, the 401k investment options are very limited. The IRA, however, are not. That's a self-directed account. So you actually get to choose, what individual stocks. You can choose, funds. You can choose whatever. So it's your money, your bank account. Do what you want. This is through the employer. They have a little more control, so they tell you, okay, these are the funds, and that's it. But there's tons of funds, and they're well diversified. They're great funds for the most part. You just have to look through them yourself. You have to do some work. Sorry. Fees. 401k has higher management fees than the IRA. And age, 59 and a half. That's when you can take out the money with no penalty, right? Awesome. So that's the chart. There's a few side notes here. As far as borrowing money, you can borrow money from all of them here. The 401k, you can borrow up to 50% or $50,000, whichever is less, and you can borrow it over a term selected up to 5 years, and that money would basically get deducted from your check automatically, whether you're paid weekly or bi-weekly, etc. So your check's going to go down, and there will be an interest rate on this. However, this interest you should get this back. Assuming the loan is paid off before you get fired or leave the company, this interest should go back to you. So, that's 401k borrowing. Don't do it though. Don't do it. Trust me. IRA, yes, you can also borrow, but you must pay back within 60 calendar days. So, yeah, don't do that either. Who the hell? I don't know. Anyway, tax benefits, right? Tax benefits. This is important. Listen up now, okay? Traditional 401k, the tax benefit. It reduces your current taxable income that year. So it's 2019 right now. If you're contributing pre-tax dollars to a traditional 401k, at the end of the year, you're not going to see that money on your taxable income because you chose to defer. You're going to pay the taxes later. It'll be on your taxable income when you retire. Right now, it's not. So that's the benefit up front. Now, Roth 401k is opposite. So the Roth is you pay taxes now, so versus later. So it basically okay. Now the question comes. Now a traditional IRA, it works the same. Traditional IRA and 401k pre-tax. 401k and IRA Roth, it's post-tax. Now which is better? This is the way I look at it. First, you have to look at the taxes. Will taxes go up in the future? Meaning, will you be paying more taxes, equivalent to what you're making today? Will you be paying more now or more later? Obviously, I'm going to guess more later. You always pay more taxes later. That's just my assumption. So that obviously favors the Roth. You could pay the taxes now. The other big thing for the Roth, and I didn't know about this. I don't know if a lot of people know about this. Every time I mention it to someone, they don't know about it. The Roth 401k and the IRA, you're paying taxes now, which means when you take out that money that you put in, you don't have to pay the taxes later. Also, capital gains. The money that you earn with the money that you're putting in for the traditional, you have to pay taxes with that, along with the money you put in. So you're paying taxes on the entire thing if you do pre-tax. For a Roth, you're paying no tax. No tax on the money you already were taxed on, and no tax on capital gains that you made from that money. How sweet is that? So basically, whatever's in your account, if you did full Roth or full time, that's your money. Sounds pretty damn good. Think about the capital gains too. Over 30 years, assuming you're starting at 30, 20, could be 40 years of it. So hopefully a lot of your companies are offering the Roth option. It's a great option. I don't know. Go check it out. Video's not over though, so hold on. Now, retirement age. Yes, I wrote 59 and a half. Yes, that's the common age, right? 59 and a half, no penalty. That's when you can retire at the earliest. Yeah, whatever. That, you don't know about the rule of 55. The rule of 55 is if you're laid off, if you're fired, or you quit between the ages of 55 and 59, you can actually take out money from your 401k penalty free. And I double checked this on the IRS website, and it mentioned qualified retirement plan. So I'm assuming this may not be an option. The rule of 55 may not be an option for every single retirement plan. You'd have to check with your employer. However, if it is, that's pretty awesome. So if you want to retire at the age of 55, if you say I'm retiring, from the company at that time, you can use your 401k money tax free. How awesome is that? The idea is here though, it only applies to that 401k. So the company that you just left, any 401ks that you rolled over previously you won't be allowed to take. But the 401k that you just retired from, left the company on, that's the funds that you can use. So again, the rule of 55. There's another thing here too. Section 72T distribution, which means if you have to leave the job, obviously, and you can, in order to do this, you calculate your life expectancy and then determine 5 years of equal payments to distribute to yourself. And this says any age. Again, I got this from the IRA website. So check yourself, but I wouldn't recommend it. Maybe 55, the rule of 55, which again, the rule of 55 is 401k only, obviously. It's not for IRA. Section 72T though, that applies to both 401k and IRA. So if you want to take out the money early, there is a way. I would Google that and go on the IRS website yourself. Definitely do not recommend it. But that's it for as far as the age goes. It's interesting stuff. One last thing I'll mention is all 4 of these are protected from creditors. So if you're in debt up to your eyeballs, don't worry, they can't touch your 401k or retirement or IRA. So there's always that. So anyway, so yeah, these are the main 2 retirement accounts, the 401k and the IRA. Have one, have both. You can never have enough money for retirement. Social Security, yeah, it is what it is. I'm sure it'll be around. Everyone says it won't be, but it'll be there. Will it be enough? No, it won't be enough. So if you want to live a good life, why not just, you got to put in money to the 401k. Let it grow in time. Contribute what you can. The idea is 15%, is the number people use. Assuming you're out of debt, you should put 15% of your money away to retirement. That way, when all's said and done, you should be sitting very pretty. So again, these are just some statistics on these 2 retirement accounts. Hopefully your job offers you a 401k, and again, check to see if they offer the Roth option, because you can just pay the taxes now and then be tax-free later. Again, on the money you put in and the capital gains. That's very nice. Anyway, that's it for the video. Hope you enjoyed it. Leave a comment below on what you have. Do you have a pension? Do you have a 401k? Do you have an IRA? If you don't, why the hell not? What are you waiting for? Do you have an excuse? Did you like this video? Let me know, alright? Thanks for watching.